What if I told you that most people in the stock market don't lose money because they're stupid? They lose money because they're emotional. They panic, they chase, they hope, they pray, and then they lose everything. In 2000, in 2008, in 2020, millions of investors were wiped out. But one man stayed calm, stayed patient, stayed rich. While others were crying, he was quietly buying. His name? Howard Marks. And today, I'm going to show you how his thinking can protect your money in every market. No hype, no fake promises, just reality. Watch till the end, because this may change how you invest forever. Let's be honest, most small investors fail, not because they lack information. We live in the age of YouTube, Twitter, Reddit, AI. Information is everywhere, but still 90% lose. Why? Because when money is involved, logic disappears. Fear takes over. Greed takes over. People buy when prices are high. People sell when prices are low. Exactly opposite of what they should do. This is the trap, and Howard Marks understood it early. Howard Marks is not a flashy billionaire. No Lamborghinis, no Instagram lifestyle, no hype. He is a thinker, a risk expert, the co-founder of Oak Tree Capital, managing billions of dollars. For decades, he has helped institutions, pension funds, and governments protect their money. His memos are read by the world's smartest investors. Even Warren Buffett reads them. Why? Because Marks doesn't teach how to get rich fast. He teaches how not to get poor. Howard Marks believes one thing deeply. If you avoid major losses, you don't need heroic gains. Think about that. Most investors dream of 100% returns, 500% returns, crypto jackpots. Marks dreams of not losing, because he knows a 50% loss needs 100% gain to recover. A 70% loss needs 233% gain. Most never recover. So his first rule, survive. Everything else comes later. Howard Marks says, markets move in cycles, always. No exception. It goes like this: optimism, excitement, euphoria, greed. Then, overconfidence, bubble, crash, fear. Then, depression, pessimism, opportunity, and again. Most investors ignore this. They think, this time is different. It never is. In 2000, .com. In 2008, housing. In 2021, tech and crypto. Same story, different names. Marks watches the cycle and positions himself accordingly. Here's the uncomfortable truth. Your biggest enemy in investing is not Wall Street. It's not hedge funds. It's not algorithms. It's you, your emotions. Fear makes you sell bottoms. Greed makes you buy tops. Hope makes you hold losers. Ego makes you refuse mistakes. Howard Marks says, being above average is easy. Being superior is hard. Why? Because it requires emotional control. Most people don't have it. Professionals train it. This is one of Marks' most powerful ideas. Second-level thinking. Most people think like this. Stock is going up. I should buy. That's first level. Second-level thinkers ask, why is it going up? Is it overpriced? Who is buying? Who is selling? What happens if expectations fail? Example. Everyone loves a stock. News is positive. Analysts are bullish.
Price is high. First-level thinker buys. Second-level thinker says, everyone already believes this. Where is new money coming from? And waits. This is how smart money thinks.
Another key rule: margin of safety. It means buy with a cushion. Don't pay full price. Don't chase hype. If something is worth $100, buy at $60. So even if you're wrong, you're protected. Marx learned this from value investing legends. This is how he reduces risk. Not by prediction, by preparation. All these ideas are explained in his classic book, The Most Important Thing. It's not about charts. It's about mindset, risk, cycles, psychology, discipline. Many billionaires credit this book for changing their thinking. So far, you've learned why most investors fail, why survival matters, how cycles work, why emotions destroy wealth, how smart thinkers differ. But this is just the beginning. Let's talk about reality. Small investors face 3 problems: no inside information, no big research team, no second chances. One big mistake can wipe you out. That's why Howard Marks's style is perfect for small investors. Because it is built on protection, patience, precision, not gambling, not guessing, not hype. Marx never risks everything. He controls position size. Simple rule: never risk more than 1 to 2% of your capital on one trade. Example: if you have $10,000, maximum risk equals $100 to $200. That's it. Why? Because small losses are survivable. Big losses are not. Most traders die, not from one bad trade, but from one big bad trade. Howard Marks doesn't ask, what stock should I buy? He asks, what mood is the market in? There are 2 dangerous moods: extreme greed, extreme fear. When everyone is greedy, prices are dangerous. When everyone is terrified, opportunities are born. Example: when headlines screamed disaster, smart money was buying. Marx buys when others are afraid and sells when others are confident. That's contrarian thinking. That's power. Marx believes in diversification. Not too much, not too little. Balanced. For small investors, a simple structure: 40% strong large caps, 30% index funds /ETFs, 20% high quality growth, 10% cash. Why cash? Because cash equals opportunity. When markets crash, cash becomes gold. Most people have no cash then. You will. Buying is easy. Selling is hard. Marx sells when prices become unrealistic, risk increases, returns become limited. 3 exit rules. Thesis is broken to exit. Valuation is crazy to exit. Better opportunity to exit. Not because of fear, not because of noise, because of logic. Here is the complete system. Step 1. Check market cycle. Is it fear or greed? Step 2. Select quality strong business, strong balance sheet. Step 3. Demand margin of safety. Buy cheap, not popular. Step 4. Control risk. Small position, clear exit. Step 5. Review constantly. Learn, improve, adapt. Follow this, and you avoid 90% of mistakes. Let's imagine this. Stock XYZ, fair value $100, market panic price $65. Everyone is scared. You analyze. Business strong, debt low, cash flow stable. You buy at $65. Stop loss $55. Target $95. Risk equals $10. Reward equals $30. 3-to-1 ratio. That's intelligent investing. That's Marks thinking. After decades in the market, Howard Marks reached one conclusion. You can't predict, you can prepare. You will never know tomorrow's crash, next recession, next boom. But you can be ready, with discipline, with patience, with humility. That's how wealth is built, quietly, slowly, safely. All of this wisdom lives in one book. The most important thing, not a get-rich-quick guide, a get-rich-right guide. If you master its lessons, you won't just make money, you'll keep it. Remember this, average investors chase returns. Smart investors control risk. Legends survive everything. Be smart, be patient, be disciplined. If this video helped you, like, subscribe, comment, discipline, because discipline is the real secret.